Last week, my next guest published a research report titled Market Outlook Does Not Depend on MAGEC Stocks. Joining me now, BMO Capital Markets Chief Investment Strategist Brian Belski. Brian, sacrilege, my man, sacrilege. All right, so you made 3 points in your piece. I want to share them with the audience and then get further clarification. Outperformance of large stocks seem to be peaking. The S&P 500 has held up following prior peaks in mega cap outperformance, and there's been little relationship between the performance of the index and its 5 largest stocks. Bold talking, but listen, I got to give you props because you've been leaning toward this for a few months now.
We have. Thank you so much for having us. You remember when we were on late last year, we said 2024 was going to be the Jackie Moon year, meaning everybody love everybody, got to own a little bit of everything. And I think people have been way too focused on these large stocks only working. And the historical average going back to 1949, when you take a look at the 5 largest stocks in the index, it's about 25% of the index return is actually comprised of these 5 largest stocks historically. However, this year, 2023 is roughly double that, and even so far more this year still concentrated. So I think people are kind of freaking out, quite frankly, Charles, in the performance of the market in July when we've had this rotation into small cap and in value and things like this. But we've been calling this for several months that the market desperately needs to broaden out, and not at the cost of these big stocks. So from a thematic and strategic perspective in terms of running money, we think you treat those names as kind of your core names, and then look to trade down into kind of second-tier technology names, let's call it, if you want to call Oracle a second-tier name on a relative basis, but really start to own more small cap and value as the standard deviation environment continues to be much more volatile. The earnings environment is much more volatile and kind of leads us to more of a stock-picking type of situation in markets.
You know, it's interesting because, yeah, some of those names, like you said, Oracle, those were the high flyers of yesteryear, and we forget that they're great companies. They can, they're motoring along. They don't have the breakneck growth that they once had. But it sounds like then the earnings that have backed these mega cap names, though, there's no questioning that they've had the earnings so far. So do you hold them until they stop producing those kind of earnings?
I think these are the new consumer staples names, and they are franchise. Your prior guest used the term category killer. These are category killer type stocks. And until proven otherwise, until they start to fundamentally decelerate, and leaders can do that. Look what's happened to look what's happened to Cisco the last 20 years. Or remember IBM was never going to go down, or even the autos or GE. I mean, all stocks kind of go through these phases. So from a fundamental perspective, that's why it's so utterly important to be looking at fundamentals and not just performance and not just momentum. So we think for now and for the foreseeable future, let's say the next 3 to 5 years, these are your core holdings. It doesn't mean you have to be massively overweight. You want to kind of go down into the Oracles, AMDs, Broadcoms, still very, very large companies, but also from an earnings perspective, you're going to receive earnings stability from these big names, Charles, but where we see the growth and the trajectory of growth surprising will be in big cap financials, especially the money center banks, some of these other tech areas, industrials, parts of healthcare. So we're going to start to see distribution of earnings growth across the market cap spectrum and across the sector perspective, which, oh, by the way, is very positive for U.S. equities.
All right, so where does that put the small cap rally? Coming into the week, thinking was changing over the week and that it was a flash in the pan. They outperformed yesterday. They're outperforming again today, despite all of the, listen, we know tons of money have also come into them, record-breaking money. Where are you with respect to the small cap rally?
We love the small cap rally, and we love this overreactionary one day they don't work. I mean, that one day doesn't make a trend. That's one of my favorite sayings. and you have to be an investor, man. You got to go to where the puck is going, not where it is right now. And we really think I said this, I think, on your channel before. I think 5 years from now, Charles, man, we're going to be kicking ourselves that we weren't buying small cap growth, small cap value, mid cap. The small mid cap universe. You always want to want to buy scarcity and sell capacity, buy scarcity and sell capacity. The number of companies is diminished. It's only 7% of the total investable market cap perspective of all market cap of stocks. Think about that. So, I mean, that's basically Apple. If you really, Apple versus the entire small mid-cap universe.
Right.
So
Right.
think about the small cap, the cash flow, the return on equity, and the earnings and dividends that these companies are throwing off. When you and I learned the business a long time ago, they didn't have dividends, they didn't have earnings, and I think it's a much different landscape.
Brian, good stuff, my man. Good stuff. Congratulations. You've been spot on.